In this session, I'll be introducing you to the world of capital budgeting. Actually, capital budgeting is a kind of a process to evaluate capital projects. Every company is having some kind of capital projects. What are these capital projects? Any project whose life is for more than 1 year. I invest something and I get the benefits out of that particular investment, not just within this financial year, but for several years. All these things are considered as a part of capital projects, and any kind of investment decision I'm taking with respect to these capital projects are called capital budgeting decisions. Now, in every company, these decisions are really significant decisions. Not everyone can make these decisions. Why? One, because these capital projects go for many years, whatever their composition is, they go into the long-term assets category of the balance sheet. Right? They are the long-term assets of the company, and they decide the future of the company, because the investment once made, you cannot reverse it so easily. The investment decision that you have made once, if you think that it is a mistake, it is very costly to rectify that mistake. So, which means you should take utmost care while taking the decision itself rather than repenting at a later stage. So, what people look at is the capital budgeting decision is really a significant decision to make within the company. And moreover, whatever the principles that capital budgeting is based on, which we would be looking at slightly in a short while from now, those principles, they are applied to almost various areas of finance based on the understanding that these principles which capital budgeting is using are really extraordinary, are really realistic. The principles of capital budgeting are used today in various spaces of finance where we are valuing working capital. The same process, the same principle of capital budgeting are applied in working capital decisions. In kinds of different leasing decisions also the same principles are getting applied. The mergers and acquisitions, similar kinds of principles are getting applied, which mean the concepts and principles of capital budgeting are so robust that they are finding their applications in almost different fields of finance. And even the valuation mechanisms which are used, which we would be discussing later, the valuation mechanisms, the net present value method. So these kind of valuation mechanisms which are used in capital budgeting, they are used even in security analysis. In the investment space also they are used very heavily. So they are used in security analysis, they are used in portfolio management kind of areas, and the kind of interlinkage is so that even the innovations that are happening in these areas are slowly coming into the capital budgeting, which means there is a lot of interlinkage that is existing between capital budgeting decisions and the valuations of the companies as such. So it's very much important for us to understand the importance of capital budgeting, how to make a capital budgeting decision, because it plays a very important role in the future of the company. So just to understand, or just to get started with the understanding of capital budgeting, I am going to look at the process. The first step which I am looking at is the process of capital budgeting. And we see that some capital budgeting projects could be very complex. The decision could span multiple brainstorming sessions, multiple evaluation sessions, because of the complexity and because of the heavy cash flow that is involved in them. And but generally, when I look at the overall process, okay, we can look at it as a 4-step process. The step 1, idea generation. Generate the ideas where to invest. So probably from a company's perspective, probably it can come from some department, it can come from some individual, or it can be coming from the top management, anyone, or it could be an external idea altogether. So the first part is generate different sets of ideas which require some kind of an investment to pursue. Once the ideas are there, then we talk about analyzing or evaluating that individual ideas. Analyzing the proposals relating to different kinds of ideas, wherein we are more looking at the cash flows. What would be the futuristic cash outflows as well as the inflows out of that particular investment? When I should invest, when can I expect the returns from it, how much can I expect from each of in each of the future years? That is what we are trying to make as a part of the analyzing proposals or forecasting the cash flows. And based on that, we evaluate the profitability of the project, evaluate the viability of the project. We will be using some mechanisms at a later point, how to evaluate the viability of the project or the profitability of the project using net present value, internal rate of return, etc. as some of the mechanisms for evaluation. Then, now this is where we will plan for the capital budget, means we will allocate the budget. Now here is where one additional step, okay, project is feasible. Now before I allocate any budget to it, I have to pool all the profitable projects, and once I have pooled all those profitable projects, I need to see the fitment, the complete fitment within the organization, because individually the project may be more and more profitable, but when I try to integrate it within my other projects, probably the project is not adding any significant value. So I will be looking, I should be looking at from a strategic perspective, is this project really worthy for me? See, suppose I am more into real estate projects, taking up one assignment in food processing may be a viable project in isolation, but as a part of my real estate group, it may not be a good fitment because it requires too much of new learning, new understandings. It's a completely different business for me. So, for me, who am a real estate business, the food business may or may not be a good fitment at all. So, though I have evaluated the project and I have found it is more and more profitable, I need to look at it with respect to the fitment. I need to look at it with respect to timing. Sometimes it's good to execute a project right away, whereas sometimes it might be a better thing to wait for an year and then try to invest in that particular project. So once we have really evaluated the successful projects, we will look at the fitment of the projects, we will look at the timing of the projects, and we will look at the prioritization, which one should get executed first, what next. So this is very much important because we have to allocate resources accordingly. We have to allocate resources accordingly, so that's a very important decision to take. And finally, it is the process of monitoring as well as post auditing. So in a post audit, whatever the decision that I have taken, I am comparing the actuals with the predicted. Seeing major differences, what are the major differences that are occurring, where are the deviations occurring. Basically, for various reasons, we will do this monitoring exercise. One, we can correct the systematic errors, especially by forecasting models. Are they overly predicting or are they underly predicting? So the systematic errors can quite comfortably be corrected. And if at all the performance is out of control, it can be identified at early stages and try to match with the predictions. So the control operations can happen quite at an earlier stage, and of course in the future I can be very careful about my investments. Okay, these areas are more and more better to invest. These areas do not return anything for me. So better pull out the investments in those areas which are not profitable and try to invest in only those areas which are going to generate some positive benefits. So this goes as a part of the typical capital budgeting process. It starts with generating ideas where to invest, then evaluate each and every idea for the profitability. And once I have pulled up all profitable projects, look at them as a part of the overall fitment, look at the timing when they needs to be executed, schedule them, prioritize them, and allocate the resources and budget for them. Once that entire activity is done, now it's a process of monitoring and auditing the project to make sure that you know what are the mistakes that have happened, you know what are the improvements that need to be done out of that exercise, and you know how the investments can be made in the future as a learning from that particular exercise. But yes, overall, the planning is a very, very complex exercise. Whenever we talk about the plan for capital budgeting, one thing that comes out, yes, it's a complex exercise. It requires many people to typically get into the decision making process. It requires understanding of various fields. Probably I may have to understand the marketing department. How do I market the product? I need to understand the engineering that typically goes into that particular product, the science behind the development of the product, and even the regulations, the taxations, almost wide varieties of areas needs to be understood, and even the behavioral related issues. How are customers going to react to this particular product? All these things need to be understood. All these expertises need to be pooled to make a capital budgeting decision. So that's the reason people at lower levels in the organizations, they get a chance to make capital budgeting decisions only up to a specific budget. They can't make all capital budgeting decisions. Only low to moderate kind of budgets would be allowed for the lower level management to take decisions on. But when I look at the large and very, very complex assignments, typically they go to top management, and finally it is the responsibility of the board of directors of the company to make sure that whatever the capital budgeting decision the company is making, it is in the interest of the shareholders itself. Now, just to understand the classification of the capital budgeting projects, if I look at the different types of capital budgeting projects which we encounter within the organizations, one, I can look at them as replacement projects. I replace the old with the new. But even that is a kind of a capital budgeting project, because it involves one, huge capital, two, the benefits and the implications are there for more than 1 year. Then we look at expansion projects, company expanding geographically, company expanding business line wise. So there is an expansion project. We are talking of new products and services as one more type of capital project. And we can even look at some regulatory, environmental kind of projects, regulatory or environmental or socially sensitive kind of projects, and probably the other category of projects which are typically called as the pet projects of the management, right? So if I look at each one of them, replacement projects, under two conditions I can look at them. One is a replacement because of breakdown. Probably one of my equipment has broken down and it needs to be replaced. So I have to purchase a new machine or a new equipment. Now here, if that machine is not replaced, then my production may halt. If it impacts the production very badly, or if it impacts the sales very badly because of that breakdown and that requires an immediate replacement, then it's a easier decision to make because there is no other go. I have to replace it. So there is not too much of evaluation that goes on whether I should invest in it or not. So we generally don't make very heavy analysis and decision making for those replacement projects which have where a breakdown has happened and they need to be replaced, otherwise the operations do not happen, which are going to impact the operations and the regular business cycle. They are going to be replaced in any way. But the replacement in search of efficiency, I want to replace this machine. I'll buy a new machine which is more sophisticated, which can produce so many items in a minute compared to my existing machine. So it's not a breakdown. We have one machine which is generating products. Now we are in search of very highly efficient, powerful machine which can generate many more products per hour rather than the existing. So that kind of a replacement where we are talking of in search of efficiency or improvement over the current stuff, then it requires a lot of detailed analysis, because there I may have to see how much additional is being produced by the new machine compared to the existing machine, in how many years, how much of additional investment is required for that, how many additional products it can produce, whether it is viable or not. So replacement with an intention of breakdown and an impact on the regular process, the decision is quite easier and quicker, whereas here it requires a lot more detailed analysis. When I look at the expansion, it's more of growing in size. The size of the business is going to grow either in terms of line of business or in terms of geography or whatever it is. So there are so many uncertainties involved compared to the replacement projects. We see so many uncertainties in this expansion business, so they need to be evaluated very carefully. Even the expansion with respect to the products and services, even here you see so many uncertainties coming up and they need to be handled quite effectively. So the capital budgeting project process with respect to these things is more time consuming, as well as it requires much more careful analysis. And when I'm talking about the regulatory kind of projects, some projects are mandatory by the government, especially greenery. If you are setting up an industrial area, probably to some area the roads needs to be developed, the greeneries need to be developed. So there could be some projects from the government or some projects from the environmental authorities which are a mandatory stuff in case you want to go ahead with one of your private projects. So there is a cost that is involved in these projects, probably no revenue, because this is a mandatory step if you want to go ahead with your regular project, because your regular project might create some kind of environmental issues, might create some kind of regulatory issues. So you may have to invest to become compliant on all these lines, wherein your investment may not receive any kind of revenue in return. But in order to maximize your private interest, you have to take up these kind of projects. Generally, companies take them up and they operate these kind of projects on a regular basis. But sometimes it so happens that these projects are becoming so costly that they may want to scrap their entire project or probably shut down some of their business which is specific to this particular project and probably get out of it. So that is where the capital budgeting decision will really help them out. What is the cost that is getting incurred with them? Is it so high compared to the benefits that the private project is coming for us? If it is so high, probably it's better not to pursue the same. In all these cases, I do some kind of capital budgeting analysis wherein I evaluate the project, and after that only I take the investment decision. Whereas there could be some projects which are the pet projects of the management, the CEO, or any senior official in the company, the pet projects of them, even without doing any proper analysis, we are going to take them up because the senior management believes that that project is going to have lots and lots of future potential. So a blind investment is going to go in those kind of projects without too much of detailed analysis happening on it, right? So this is how we can very well classify the different capital budgeting projects, and some of them are easy to make decisions, while some of them will take more and more of resources, more and more of time, more and more of capital in terms of making the decisions itself. Now, what are the key principles involved in capital budgeting? Earlier, I was talking of the various principles of capital budgeting. They are used even in the other areas of finance like working capital, leasing, mergers and acquisitions. So now it is for us to understand what are these principles of capital budgeting. So some of them, whatever the decision that we are making, the decisions are based on the cash flows, not the accounting data, not on the accounting concepts or the accounting profits. They are made on cash flows. A very interesting aspect, because accounting profits, accounting concepts are specific to countries, or probably they are specific based on the accounting standard that is being chosen, the accounting principles that are being followed. But when it comes to cash flows, it's a real world thing. It's a real thing. Whatever is the accounting standard that I am following, my cash flow, which is a reality concept, it's not a virtuality. Accounting principles, when there is a profit of some X, I can't show it anywhere except in my books. But when I say my cash flow is this much, I can show cash net in my bank account or in my drawer. So that is where the whole capital budgeting believes that any decisions need to be made on cash flows, not on accounting income. And as a part of this cash flows, any kind of intangible related costs and benefits, they should not be included, because if they are real, they would have incurred some kind of cash flow. Either they could have given some kind of reduction in the cost, or they should have improved the sales. So they are not directly included as a part of the cash flow. So we do not include the intangibles and the benefits because they are not real, and if they are real, they would have come as a part of the cash flow somewhere or the other. Then the time value of money, which talks about the timing of the different cash flows when they are occurring. Right, so the time value of money concept is very much applied in the capital budgeting analysis. Then we are looking at the opportunity cost. See, when I am trying to invest somewhere, when I am trying to invest, let's say for replacing a machine, an older one with a new one, right, my capital is getting blocked in the new machine. I could have invested it elsewhere and I could have earned a return on it. Now, what is that return I'm foregoing there to invest it here is what we call as our opportunity cost. Right? So we have missed out an opportunity of investing my money in a bank deposit and I have invested it in this project. So whatever the cost that I am foregoing, whatever is the return that I am foregoing is like a cost for me, and that is the cost I am associating it here as an opportunity cost. And we are looking at the incremental cash flows, especially in case of replacement projects. So I'm replacing an old machine with a new, right? So old machine was giving me some kind of cash flows, some kind of revenues each year. The new machine is expected to give an additional cash flow. Now we are scrapping this and we are replacing it with this, which means I would be considering only this as the additional cash flow that is coming up from the additional investment in the project. So we are evaluating only the incremental cash flows, especially in the replacement kind of project. Then we also talk about the cash flows being considered always after tax, because whatever the cash that is getting generated, there is a tax levied by the government which does not go to the investor, which goes to the government without any kind of hesitation on that. So which means what goes to the investor is only the post tax part of it, and that is what we consider as a part of the cash flow analysis. Then while computing the cash flows, we do not consider the financing costs, which means the cost of borrowing, the interest that needs to be paid on the borrowed funds. That will not be considered as a part of the cash flow analysis. Why? Whenever we do the capital budgeting analysis, what we do is once we find out the cash flows, we discount those cash flows using the time value of money principle. We discount them at a required rate of return. Right? We'll look at them when we take up a few numericals. But we discount these cash flows at a required rate of return, and this required rate of return is more in line with the risk that is taken in the project. The risk that is associated with the project, based on the riskiness that is associated, the required rate of return is going to come up. And this is where the cost of borrowing is also the cost of capital, which consists of the equity capital as well as the borrowed funds. So the total cost, how much it is costing for the entire capital that is invested, the discount rate is determined based on this cost of capital or the opportunity cost that I am losing because of investing in this project rather than investing elsewhere. So what happens is the discount rate which I am using to evaluate the capital project, that is taking care of the financing costs. So I don't need to take care of the financing costs as a part of the cash flows. Otherwise it becomes a double counting of the same. So in any kind of cash flow computation, we only look at the operations based cash flow only. Only operating cash flows are being considered, but not the financing related cash flows, the cost of borrowing, the cost of equity payments that need to be done. They are all not considered as a part of the cash flows, rather they are considered as a part of the discount rate which is used to find out the worthiness of the investment. And capital budgeting, as I said, it is not based on accounting profits. It has to be more and more based on the cash flows only. So the determination of the cash flows and the determination of the discount rate, which is the required rate of return, both of them are very crucial while doing the capital budgeting analysis. And a few more important points to consider. Sunk costs should not be considered, because sunk cost is a cost which we have incurred already. Whereas any decision that we are taking today is based on today's investment. It is not based on past investment. Past investment should not be considered at all as a part of the capital budgeting analysis. It is the current investment and what are the benefits and the costs that are going to come up only in future. The cash flows relating to current and the future are considered as a part of capital budgeting analysis. We will not consider the past. So sunk is something which we have already incurred, and any capital budgeting analysis will not incur the past costs at all. They are not going to have any kind of impact on the decision. Only the current and the future cash flows will have any kind of an impact on the decision. So when I talk about this opportunity costs, how much I have foregone. So probably the better way to talk of, okay, let's say I have an idle house and I want to use it for my business. I already have a house and I want to use it for my business. Now what is the opportunity cost here? I could have rented this house and I could have got some rent on it. Whatever, let's say X is the rent that I may get on this particular house. But I am using it for the business because it's my own house. I'm using it for the business. So which means as a part of the business, if I have to go for the cost relating to the use of this idle house, I'll take the market value of this house and associate it as the cost for it. Though it's not costing me anything, but I would always look at the cost of that particular house. Had I rented it to someone else, what is the current rental value associated with that particular house? And if possible, even I can talk about the overall cost price of that house itself, because it's as if I have used it permanently for my business rather than renting it. Then I'll take the market value of the house itself and use it as a part of the fixed cost for the business. Or if I have let's say $1 million with me, and I can think of putting this 1 million in a fixed deposit versus investing in the business. So I could when I had invested the same 1 million here, I would have got, let's say, some 9% return every year. Because I did not invest this money here and I have transferred it here, my opportunity cost is that foregone 9% interest that is coming on that 1 million. So these are the different ways in which I can look at this opportunity cost, right? And whenever we are talking of the incremental cash flows here, yes, with the decision, what are the cash flows? With the new investment, with the new decision, whatever, what are the new cash flows that are going to come? Minus without going ahead with the new decision, what are the cash flows? So that increment only is being considered, not the complete cash flows. Then one more important factor is the externalities need to be visualized as a part of the valuation of the capital budgeting decision. See, sometimes any decision that we are making, it can impact the other parts of the business, of the same business. So I have introduced a new product, it can kill my existing products. It can bring the customers, my customers who were using an existing product, they would be switched on to the new product. So I have to consider only the incremental part, especially when externalities are there, or in some cases even the impact could be there on the society as such, which means that additional cost which the society would be incurring also should be taken care as a part of my capital budgeting decision. Or in some cases the society could benefit from the execution of my project, even that society's benefits need to be added up as a part of my capital budgeting analysis. So externalities, any externalities that are going to come up where there could be an impact on the other departments or other products of the company or society. In society also there could be a positive side where the society could benefit from my project, or society can get harmed from my project. Any of these things need to be visualized and need to be taken care of. One of the major externalities that we look at is cannibalization of the product. Whenever I introduce a new product, it might very well happen that it can kill my existing products itself, which means whatever is the new revenues and new profits and new cash flows I am expecting from my project is at the expense of losing some of the sales profits from my existing products itself. So even there I have to focus more on the incrementals only. And coming ahead with a few more concepts, sometimes in this capital budgeting we use words like conventional cash flow versus non-conventional, especially in very simple terms. If I am looking at initial outflow, initially I have spent, and after that regular inflows, which means if I look at the outflows with a minus sign and inflows with a plus sign, if I see that the sign change is occurring only once. So once I have completed all the outflows, it's only the inflows coming up from the project, then we call that as a conventional cash flow model. Whereas if there are multiple sign changes, means okay, today I have invested something, so I had a negative cash flow. It in the next couple of years it has generated some positive cash flows, but there required some other investments happening. Again one positive cash flow, again a negative cash flow, and after that positive. Which means if I look at the 10 years, this is how if my cash flows are looking at, which means multiple sign changes, multiple investment periods coming up, then we say that these kind of cash flows are more and more non-conventional in nature, whereas these kind, probably in this I see, even if it is multiple years, initially I am investing everything, and after that whatever is coming out is going to be a positive cash flow itself. So this is one important thing that we need to consider as a part of the capital budgeting projects. What is the methodology of my project? Is it more a conventional kind of a project like this, or does it require investments at different points in time, working like a non-conventional project? Then I have to see whether my projects, if I have evaluated a few projects and I found that all of them are profitable, I have to see whether those projects are independent or mutually exclusive. When I say independent, if let's say three projects are profitable, I can take up all three of them, right? Because the cash flows of the project are independent. There is no dependency on each other. If they are profitable and if I can afford them, I can invest or I can take up all the three projects. But if they are mutually exclusive, they compete directly with each other. So if I take up the first one, which is profitable, I can't take the second and third. So I can take up only one of those three projects, though three of them are profitable because one of them is competing with the other. So those kind of projects are mutually exclusive. So once I have evaluated the projects for their profitability and viability, I really need to see whether they are independent or mutually exclusive. If they are mutually exclusive, then probably I have to choose only one out of all the available projects. And in some cases, I may have to focus on the sequence of the project as well. Sometimes, whatever the three projects that I have evaluated and found them to be worthy, it may so happen that this can be executed only based on the results of this. I can't start both of them at the same time. I will think of investing in this based on the success that I get out of this project. If this project is not successful, if this project is not giving me the benefit as I expect, probably I don't want to go ahead with this project at all. So this is where, though there are three projects which are profitable, if I see that they can't be executed parallelly, but they can be executed only in a sequence based on the evaluation of the financial results of the previous, which means right now I have the opportunity to execute only one, not three projects, though all three of them are looking profitable. They are not independent, they can be executed only in a sequence. If the results are profitable, I'll go ahead and execute them, otherwise I can drop them. One more important consideration that comes up is, do I have unlimited funds to invest in all the profitable projects that I am getting? Assuming that they are independent, do I have sufficient funds to implement to start off, because each project requires an initial cash outflow? Do I have that much of cash outflow, and can I raise capital to whatever extent I can in case I find projects which are profitable? In that case, I call that I'm having unlimited funds, but most of the companies have the situation of capital rationing, where there is a limit on the funds that they can use, right? They have only fixed amounts to invest. So though there are three profitable projects which are independent, not mutually exclusive, but still they can't take up all these three profitable projects because of the capital rationing. They have a fixed amount to invest, so they have to allocate the fund more and more appropriately. They have to choose which out of these three is the best, or one or two of them out of the three, which are going to maximize the base behind this is maximize the shareholders' wealth. Whichever projects or set of projects is going to maximize the shareholder wealth, that is what is going to be considered based on the capital rationing constraints that are being put up for the organization. So these are some of the important principles as well as important concepts that we need to be familiar with respect to the capital budgeting process and the capital budgeting decision making. All right. In this session, I will be looking at the different criteria which are used to evaluate the investment decisions. We would try to cover a few important tools, the two popular of them being NPV and IRR, the net present value, as well as the internal rate of return. The two most popular tools for evaluating the feasibility and profitability of any investment, any capital budgeting decision. Though we would also look at a few more commonly used kind of tools where the focus is on payback period. We would look at the discounted payback period. We would look at the accounting rate of return, and we would also try to focus on profitability index. The last four of these are used by some organizations in some form or the other, but the most widely used and the most commonly used decision taking criteria for the capital investments form to be the net present value and the internal rate of return, right? So with that as a background, and probably what I can do is we'll take up a small data set as well to try to understand it much better. So let's say I talk about the different years right now: year 0, after 1 year, 2 years, 3 years, 4 years, and 5 years. So let's say I talk about a project cash flows. So initially, let's say I'm going to invest some $100 million, which the project might generate, let's say, around 25 million in the first year, 30 in the next, 35 in the next, 40 in the next, and 50 in the final year. So let's assume that these are the cash flows that are generated by a project 1, and probably I will take project 2 as well, just for some kind of understanding. I'll take the project 2 and look at the cash flows of project 2. Probably let's say I'm investing 50 million in that particular project, and this particular project is going to give me exactly, let's say, the reverse, right? So 25 million in the first year, let's say 20 million in the next, 17 million in the next, 15 million in the next, and another 12 million in the last. So let's say these are the two kinds of projects I'm looking at. The first one is giving something in this way, the second one is giving me something in this way. Now, how do I evaluate which of these two projects are more profitable to me? Which of these projects need to be taken up? So for evaluating these projects, so first of all, this is how any project evaluation goes. I have a project where I have some capital investment done, and based on that capital investment, I am expecting some kind of cash flows in the future. A capital investment done, expecting some kind of cash flows in future. So these two projects are 5-year duration projects. Now, if I have to evaluate them, the first tool that is used for evaluation of these capital projects is the net present value. So whenever I am using the concept of net present value, It is simply defined as the present value of all future cash flows and the current. The present value of all current and future cash flows is what we call as the net present value of the investment. So if I am saying that, okay, right now I have invested some CF0 and probably after 1 year I might get or I might pay CF1, then CF2 is the net cash flow. Here when I am seeing cash flow, it is the net of outflows and inflows. Inflows are generally treated with a positive sign, outflows are treated with a negative sign. So the net is what I am showing every year. So if in this year, let's say 30 million is the outflow and 50 million is the inflow, probably I'll directly write plus 20 million because the net is 20 million, right? So cash flows in first year, second year, third year, fourth year and fifth year. So if these are the cash flows that are coming up, I discount each of them with the required rate of return. So if the required rate of return is R, I'll discount each of the cash flows with the required rate of return. So in some years the cash flow could be netting positive, in some years it could be netting negative, but whatever it is, I would be discounting all these cash flows, and the current cash flow need not be discounted because it's a present value itself. So I sum up all these things and this is what I call as the NPV. Now here the most important aspect is determining these cash flows, how much coming up at what point in time, because there's a lot of uncertainty that goes around them. So identifying the exact amount that comes or identifying or forecasting the cash flows that are going to come up in the future, and at the same time deciding on an appropriate discounting rate, right? And remember, these cash flows need to be after tax only. So identifying that after tax cash flows and identifying an appropriate required rate of return which acts as a discounting rate is what is important as a part of the cash flow analysis, as a part of the NPV analysis. Now what we can do is the same formula I can try to apply for both the projects. So present values of the project 1 cash flows. What I can do, okay, so for the first one, the cash flow divided by 1 plus, now I need to finalize on the required rate of return, right, or the discounting rate. The required rate of return, let's say I'll start with 12%, we'll try to play around with it later. Right now, let's say the required rate of return is 12%, which means CF0, I do not need to take the present value. Even if I take it, it would be same as the cash outflow, the original cash itself. So for generalizing, I'll say the cash flow divided by 1 plus the required rate of return raised to the power of total years in future, the time period from now to when the cash flow would be realized. So in this case 0 years, so resulting in minus 100 itself. And when I'm looking at the summation of all of them, so this is what is coming out for each one of them. So here it is so happening 25 divided by 1 plus 12% to the power 1. Here it is becoming 30 divided by 1 plus 12% to the power 2 and so on. So from here, now if I add up all of them, I get the NPV for the first project, which comes out as the summation of all these cash flows, which is working out to a positive 24.94. Similarly, I can try finding out the present value of the project 2. Okay, the same logic I can apply. 50 million divided by 1 plus, even here I'll take the required rate of return as 12% raised to the power of 0. The same logic I'll continue for all of them, and now I can find out the NPV for the second project, which comes out as the summation of these two. So NPV for the second project is coming out to 16.7 million. The NPV for the first project is coming out to 24.94 million. For the second project, it is coming out to 16.7 million. Now, one thing that needs to be understood for both the projects, in our case, NPV is greater than 0. What does that mean? The present value of cash inflows is greater than the present value of cash outflows. Means inflows are more than the outflows. So I can very safely assume that by that much amount, the investor's wealth is increasing. So by the extent of 24.94 million in this case, the wealth of the investor is increasing, and in the second project, the wealth of the investor is increasing by 16.7 million. So it's a dollar value, it is not a percentage term. It's a dollar term, not a percentage term. So the increase in the value is by the extent of 24.94 million here, 16.7 million in case of the second. And coming out to the decision rule, when do we choose a project? When do we accept a project? Whenever NPV is positive, I say you go ahead and accept the project. If NPV is negative, directly reject the project. So if I'm looking at as a single decision criteria, as any positive NPV is resulting in increasing the wealth of the investor, any positive NPV project needs to be accepted, and any NPV negative project can be outrightly rejected. So that's how NPV can be used as a decision tool. Now, we would come back to NPV again, trying to understand a few more important aspects behind it. But for now, we will move on to another important role that is playing an important role in decision making for the investment projects, which is the internal rate of return, otherwise called as IRR. Now, there is a lot of similarity between the NPV and the IRR, because applications wise also IRR has a lot of applications in a lot of financial aspects. And in case of NPV, whatever was the required rate of return, whatever the required rate of return was based on the risk that was associated with the investment, right? And it was purely based on the market determined and more realistic kind of a rate. So what is that the investor would typically expect as a return from this investment, considering the risk associated with that investment? That is what is the required rate of return, which was set as the discount rate in the determining of the NPV mechanism. Whereas here what we are saying is, I will not use the discount rate. I will try to vary the discount rate, or I will try to change the discount rate until I find that particular discount rate which makes the present value of future cash flows equal to 0. Means that particular discount rate where NPV becomes 0, that discount rate is what we are calling as the internal rate of return. So I'm trying to look at the different possibilities where my discount rate can become my My NPV can become zero, means the present value of all cash outflows should be equal to the present value of all cash inflows. That particular discount rate which can accomplish this is what we are calling as the IRR. So the equation of NPV which we have used earlier, CF0 plus CF1 by 1 plus R, CF2 by 1 plus R squared. So whatever we have used as the equation for NPV, this is the equation we have used for NPV. R was something which came out from the risk characteristics of the project, or probably the opportunity cost associated with this investment, foregoing some other investment. Whereas here, what we simply say is all this will remain the same. Instead of putting R, I'll put IRR. Instead of putting R, which is a market determined rate, I'll take IRR. And of course, here the answer will always come out to be zero, and IRR is what we need to find out in this case. So generally, manually, it's not that easy to determine. So probably we will depend either on a financial calculator to do this calculation, or probably a spreadsheet kind of a tool has a daily, as a regular routine, has a normal formula which can directly find the IRR for me. Means that particular discount rate which can make the NPV equal to zero. So for our example, we can try finding out the IRR for the project 1. I can directly use a formula called IRR which is present in the spreadsheet. IRR of these particular cash flows is giving me somewhere around 21%. So the discount rate that we are discounting the cash flows to make the NPV equal to zero is 20.53% in the case of project 1, and in case of project 2 I can find out that the IRR is around 27%. In case of first it is 20.53, in case of second it is 26.75%. So IRR is higher for the second project compared to the first. But again, as a decision taking criteria, what we say is if the IRR is greater than the required rate of return, whenever I find that the IRR is greater than the required rate of return which we have used for the NPV calculation, we can accept the project. And whenever I find IRR less than the required rate of return, generally represented by a small r, I can very well reject the investment. And the most important thing we see is whenever the IRR is greater than the required rate, I can see that the NPV will be positive also in majority of the cases, in almost all the cases. A few exceptions I'll talk about later. But wherever in most normal cases when IRR is greater than the required rate of return, so here IRR is 20.53, required rate of return is 12. So that's the reason the NPV is positive here. IRR is 26.75. Required rate of return is 12. That's the reason NPV is positive. Just to understand, I'll try changing the required rate of return, let's say, to 25%. Now you see here the IRR is 20.53, required rate of return is 25. So IRR is less than the required rate of return. That's the reason NPV came out positive negative here. Whereas for project 2 still I see IRR is greater than the required rate of return. That's the reason the project 2's NPV is still positive. Whereas if I make the required rate of return as 30%, I see for both of them the NPV is negative because their IRR is less than the required rate of return, right? So that's one way we can really look at the IRR and try to compare it with the required rate of return to make our investment decisions, right? So that's one important aspect regarding another tool that is helpful in doing investment analysis. Then the third important tool that I'm going to talk of here is the payback period. It's simply the number of years to recover the investment. Whatever the investment that I have made, number of years it is taking to recover that. So that's a simple calculation that works for the payback period. So if I look at the payback period for the project 1, right? So for the payback periods, it's better that I compute the cumulative cash flows. Okay, so the cumulative cash flows for project 1. Okay, how do I look at the cumulative cash flows? I'll start with the first one. For the second, I'll add the first and the cash flows associated with that particular year. So it is becoming minus 75 because 25 is already recovered. So what we typically see is up to 3 years still the recovery has not happened. Only in the 4th year the recovery has happened. Right? Only in the 4th year the recovery has happened. So at the end of 3 years, what I could see is 25, 30, 35. So 90 has been paid off. Only 10 is remaining to be paid in the 4th year, but 30 was received in the 3rd year, in the 4th year, which means if I assume the uniform distribution for that same, I'll get it as 10 by 30 or probably 10 by 40 because 40 is what is being paid, is what is being received in the 4th year, but 10 receiving 10 itself will recover my overall investment. So because of that, what we are saying is if I assume that 40 is paid uniformly across the year, the 10 would have been received in 10 by 40 years, which is around 0.25 years. So what I say is the payback period in case of project 1 is 3.25 years. 3 years and 1 by 4 year, which is working out to 3.25 years or 3 years and 3 months. The same way when I look at the cumulative cash flows for project 2, it looks okay. Initially I have invested 50, but at the end of first year 25 is already recovered, so I'm just to recover only 25. And the same way if I'm going, I'm just to recover 5 in the 3rd year, I've got 17, which means during the 3rd year itself I am able to completely recover my investment. If I, when I required only 5 in the 3rd year, I got 17. So assuming 17 is uniformly obtained, 5 by 17. So in another 0.294 years, I was able to recover my entire investment. So which means when I'm trying to find out the payback period for the project 2, I'll take it as 2.294 because 2 full years and another 0.294 years. So in the second investment, probably the payback is much faster. In the second project, I am able to recover it much faster compared to the first project and vice versa. So that is what I am typically looking at when we are talking of a payback period. But of course, a few big drawbacks go around that payback period. One, the time value of money is not used. I did not discount any cash flows. We have simply done the cumulative addition of the cash flows and directly looked at the period when the recovery is happening, which means the time value of money is ignored, the risk is also ignored, the riskiness of the project is also ignored, because only the risk is what will help me identify what should be the return which I should use for the discounting purpose. And now that it is not discounted, the risk of the project is also completely ignored. And the most important part is the cash flows after the payback. They are completely ignored. One of the major drawbacks here, you see, here once it has said 3.25 years, after that whatever the cash flows that are coming up, they are all ignored. It's just the time period. It's not a profitability kind of mechanism. It is nowhere talking about profitability. It is only talking about how soon I am getting my payments. Sooner payments, how quickly I am receiving my invested amount. So probably we should look at it as a measure of liquidity more, not as a measure of profitability, right? And any cash flow, see, if you see after the payback period, in this case there are very small cash flows, 15, 12, but after the payback period there are some big cash flows here. And the disastrous part of it is, even if these are negative also, it really doesn't bother. My cash flows, I'm able to recover my cash flows. That's the way I can look at the payback. So that's the reason lot of drawbacks associated with the payback period. So it's just a measure of how quickly I am able to receive my invested amount back. It's not a measure of the profitability of the project. But of course, on the positive note, yes, it is easy to calculate, right? Probably easy to explain to people, even if they don't understand the concept of discounting and all. In simple numbers with simple addition and subtractions, I can explain this concept to the people. And it's majorly a measure of liquidities. So because of the quickness of receiving the payments back, here in this case I can say the project 2 is much more liquid compared to project 3, because within 2.29 years I am able to get back my whole invested amount, but here it is taking almost 3.25 years. And it's not a profitability measure to accept or reject a project. So basically that's the reason we don't have any kind of a solid decision rule which says during only when this is possible accept the project, or only if this is possible reject it. So no decision rule, we only look at it on a comparative basis and primarily use it for the measure of liquidity, not the profitability of the project, right? Now, a few of the drawbacks that are associated with the payback period have been addressed to some extent in the discounted payback period calculation. It is also the number of years to recover the investment, right? But instead of directly taking the cash flows, we are taking the discounted value of the cash flows. Instead of directly taking the cash flows, we take the discounted value of the cash flows. So at least the scenario is working out that it is using time value of money. It is taking into consideration the risk of the project. Some of the drawbacks that were there with the original mechanism, at least it is trying to address them to some extent. So it is relying on the discounted cash flows. Now if I try to execute the same, so I will not do the accumulation on the original cash flows. In this case, I'll do the accumulation of the discounted cash flows for each of the projects. I'll not do the accumulation of the original cash flows, I'll do the accumulation of the discounted cash flows. So here I'll look at it like this. and for this I'm adding up this. So this is how the cumulative calculation happens in this case. Okay, let me try it again. So this plus whatever is the cash flow here. Yeah. So what is happening is by the end of the fourth year, still 3.42 million is yet to be received. 3.42 million is yet to be received, whereas in the fifth year, the 28.37 million is received, which means I could try to find out what is the approximate years in the fifth year. So it is around 0.12 years. So if I am looking at discounted payback period for project 1, I am calling it as 4.12 years, because 4 full years it was not able to recover the cash flows, going with the discounting of the cash flows at the required rate of return of 12%. In the fifth year it turned positive, but yeah, all that is required was only 3.4 million, whereas the present value of the positive cash flows during that period was 28.37 million. So converting it into years under a uniform receipt of the cash flows across the year perspective, this worked out to 0.12 years. Similarly, I can work out on cumulative discounted cash flows for the project 2, wherein I could look out for the project 2, the present values I'm going to consider. So this plus whatever is the cash flow that is coming up in the first, and taking the concept here, what I could see is in the third year it was able to complete the process. But yes, again here at the end of the second, 11.73 million is still to be paid, but in the third year the almost 12.1 million is received, which means I can very well try finding out the approximate number of years for 11.73 as a percentage of 12, almost 96.969, which means I can very well find out the discounted payback period for the second project. I can very well say it is 2.969 years, right? 2.969 years is the discounted payback associated with the second project. So even after taking the discounting factor into perspective, we see that the second project is able to recover back my investment at a quicker pace compared to the first one. So that's some of the drawbacks that were there in the regular payback period were addressed on the discounted payback. And sometimes what we could see is if the project has, see, probably the link I can put it with respect to NPV is, if the project has a negative NPV, to a large extent I may say that the discounted payback period might not exist at all. So look at this example. Probably if I am looking at a 25% required rate of return, the NPV for the first project is minus 10, and what I could see is this is never coming closer to zero, means the discounted payback may not exist at all for the first project. So that is what we are trying to say. Whenever the NPV is negative, the discounted payback may not exist. I am not saying that it will not, because another drawback associated with it is the cash flows. The cash flows after the discounted payback are completely ignored. So because of that, what could happen is, if after the payback period, if at all there is a high negative cash flow, So in that case, what could happen is the discounted payback period might exist, but NPV will still be negative. So that is the only case, because just like at payback period, it ignores the cash flows that are coming up after the payback period. After the payback period, whatever the cash flows are coming, they are completely ignored of. And because of that reason, what could very much happen is, if I take in the last period, let's say minus 50 instead of plus 50, what is happening is my NPV is becoming negative, right? My NPV is becoming negative, and I could sense, probably here, let me take it 50. So what we could sense is the NPV is still negative here, but discounted payback in this case is positive here, because the total cumulative cash flow has gone to positive, but after that it has gone negative. So because the discounted payback ignores the cash flows that are coming after that, I may get some discounted payback period 3 plus something. So just about 3 years I am recovering my capital, but again after that I am losing it. But it ignores the cash flows that comes after the payback period. So that's one of the prime reasons the discounted payback period also goes into so many limitations. So that's the reason, again, it is not used as a measure of profitability, right? Because of these limitations that are running out, it is also even used as a measure of liquidity itself, right? So that's one more aspect that we need to be comfortable with. Then we are talking about average accounting rate of return. Probably one of the different types of mechanisms that is typically being used. The reason is, first of all, it is based on the accounting concepts. It's not based on cash flows. But the most appropriate thing to use in a capital budgeting decision making is always cash flow based but not accounting based. But what we see is some companies typically follow this kind of a mechanism. The second thing is, it it is it is not depending on time value of money at all. It does not take into consideration the time value of money. It's a completely accounting based, profit and loss statement based kind of a calculation, where it talks about average net income which the company has generated during a period divided by the average book value. So probably this is not considering the cash flows, after tax cash flows. So it is considering after tax net income of the project, not the after tax cash flows of the project. So probably if I'm saying I have invested 10,000 bucks, or probably the sales is 10,000 in each of the 3 years, and the net income after all the taxes have been paid, let's say, is 2000 in the first year, 3000 in the second year, and 4000 in the third year. So average net income is going to be 3000, and let's say the book value of the asset, whatever we are talking of, the book value of the asset, let's say, is 50,000 bucks in the first year, and because of depreciation applied on it, it became, let's say, 40,000 bucks in the next year and 30,000 in the next year. So the average book value is taken as 40,000 bucks for that particular asset, resulting in an average accounting rate of return of around 7.5, of around 7.5%. Right, so this is the way out for computing the accounting rate of return. But of course, one, it is easy to understand. On the positive note, if I have to see, it is easy to understand saying that you have invested this much and this is what is the return that has come out of it. So one, it is easy to understand. One, it is based on accounting numbers, not on cash flows. But whatever we have discussed about the cash flows, the capital budgeting decision should be more based on cash flows, not on the accounting numbers. So it becomes a conceptual and a practical limitation of the capital budgeting decision as such. And as I said, it does not take into consideration the time value of money. And the biggest drawback, what I see, is different companies compute the accounting rate of return in different ways. The averaging that is typically being done, probably the 5 years average, 3 years average, weighted average, different ways in which that can be calculated, which means when we are just getting the number relating to the accounting rate of return from some third parties, enough care needs to be taken in terms of understanding what is the background logic in terms of computation of the same. So that's one of the prime reasons accounting rate of return may not be a very powerful tool with respect to the usage as far as capital budgeting decisions go. Then, looking at one more important aspect, which is the profitability index. In some companies, even this profitability index is very widely called as benefit cost ratio. So what is the ratio of benefits to the cost that has been incurred on it? So I can very well look at it as the present value of the future cash flows divided by the initial investment on the same. Whatever is the investment that has been put up, what is the present value of the future cash flows? In other ways, it is very much defined as 1 plus NPV divided by the initial investment. So if the NPV is positive, I see that this ratio is greater than 1. NPV positive, the profitability index will be greater than 1. If it is negative, it will be less than 1 because it is directly expressed as NPV divided by the initial investment. See, simple way to understand NPV is like present value of future cash flows minus the initial investment, whereas the profitability index is taken as the present value of future cash flows divided by initial investment. So that's the only difference between these two mechanisms. So the investment decision also goes in line with the NPV decision itself. Greater profitability index greater than 1, good for investment, otherwise not good for investment. Right? And it is heavily used as a part, as a guide in the capital rationing process where the limited resources are available, which tells me, which tries to establish the NPV in a ratio form. It will tell me for whatever is the best capital that I am using, what is the excess that I am trying to get. That's the reason it is simply termed as benefit cost ratio in majority of the scenarios. Right? So these are six important tools, though there is a lot of usage primarily relating to NPV and IRR. But again, we see at some places for some kind of organizations, even the payback period, the discounted payback period, the accounting rate of return, and even the profitability index are being used as a measures as a part of their capital budgeting investment decision. So we just need to be comfortable with these different ways in which they calculate the advantages and disadvantages that are associated with each of them, right? Now, the other important concept which I would like to cover is the NPV profiling. NPV profile is nothing but I'm looking at a graphical representation of NPV. A graphical representation of NPV for the different discount rates. So I take different required rates of return and see how the NPV is moving. So I take the discount rates on the x-axis and the corresponding NPV values on the y-axis, and whatever the graph that comes out is what I am calling as the NPV profile. So for this data, let me try computing the NPV profile. Right, so let me take right from 0%. Right, now that I want to look at the NPV profile, now that I want to look at the NPV profile, I'll take the interest rates or discount rate. Right, I'll take the discount rate one for different possibilities. So 0%, probably let me take it as 1% for each element. Let me take to understand it much better. I'll take it probably up to 30% or even 35%. Let me take it. Alright. So for these different possibilities, I want to see what is the NPV. For if the discount rate is 0%, what is the NPV? If the discount rate is 1, what is the NPV? I want to do it for the project 1. Right, so for that I'll take the help of data table of Excel so that it can directly help me compute all those numbers in one single shot. So I would use the discount rate as the column input cell, and what I'm getting is, so these are the possible NPVs that are coming up if the discount rates are these particular numbers. So now what I can very well do is I can do a graphical plot now. I'll do a graphical plot taking, I'll do a graphical plot. So here I have taken a scatter plot taking the discount rates on the x-axis and the corresponding NPVs on the y-axis. So this kind of a graph that gets plotted for me is what is being called as the NPV profile. This kind of a graph is what we call as NPV profile. And from this NPV profile, a few things that we are very much interested in is where is the graph cutting the y-axis. In this case, it is cutting the y-axis at 80. What does this mean? When the discount rate is 0, what is the NPV? The NPV when no discounting is done, when the discount rate is 0, that is the place where it cuts the y-axis. I'm seeing the place where it cuts the x-axis. So when it cuts the x-axis, that is what we typically call as the IRR. That particular discount rate where the NPV is becoming 0, that is what we have defined as the IRR. So here the IRR should match with this point which it has cut on the x-axis. The IRR in our case is 20.53%. So what we could see is exactly at around 20.53%, I might have seen that this particular NPV graph is cutting the x-axis. And probably for the discount rate, whatever we have taken, the 12% discount rate, I can see what is the NPV. It is still positive somewhere at around this 24.94, which is what we have obtained even as an NPV when we have done this calculation. So that is how we can look at the NPV profile kind of a graph. So what we see is this graph is much more looked in this way. I mean, probably you can see that there is a lot of well-behaved nature as a part of this graph. You see it as a smooth downward trending kind of a graph. Right from the y-axis, it goes down and down, and it is more and more convex to the origin. So that is how a typical NPV for a regular conventional kind of a cash flow project, this is how the NPV graph typically looks like. Now the same kind of NPV profile, I would like to look out, let's say for the same kind of an NPV profile, let's say I would like to look out for the project 2. So if I call this as a project 1, and when I look at project 2, probably if I am including the NPV of the project 2 here, okay, I'm going with what if analysis data table, and I'm inputting it in the column this particular rate of return. Okay, so here let me try to do it separately. If I'm looking at for project 2, I should look out for, I'll take the discount rate and the NPV that is associated with the project 2, wherein again the similar discount rates if I am applying for the project 2 as well, and trying to do a data table analysis even for this, what I could really notice is the column input cell, I'll point it to this particular value, and yes, this is what is coming out. What has happened here? NPV. Okay, here we have used it some of the entire D column. So probably let me use it only up to this. That will make our scenario much better. So this is what is getting worked out for the second. So which means now if I try to plot the graph, let's say including the project 1 and project 2 instead of just project 1 or instead of just project 2, let me try to plot the graph for project 1 as well as project 2. in here as well. Let me see what has gone wrong here. When the discount rate is 0, yeah, 39 is the overall positive cash flow looks like, yes. So now we can plot the NPV profile for both project 1 as well as project 2. And what I could very clearly notice is, let me try to plot these two. Okay, let me try to plot a simple graph associated with these two, probably not including this one. What we could very clearly see is, while the red one is showing the NPV profile for the project 1, the green one is showing the NPV profile for project 2. And what I could see is, at very low discount rates, the project 1 is showing a much higher NPV, but as the discount rates are increasing, I look at project 2 showing a higher NPV. And there is some kind of a crossover point here. This is the point where the NPVs of both of them are equal. That particular discount rate where the NPVs are equal of both the projects, that is what we call as the crossover rate. So below the crossover rate, we see the NPV for one project is profitable, is higher, and after the crossover point, I see that the NPV for the other project is higher. So this is where the problem comes with respect to the ranking of the projects, especially when we are having mutually exclusive projects. If I am having independent projects, or if I have to value a single project, what we could see is both NPV and IRR will give me the same decision. One in case of independent projects and two in case of single project. I could see that the decisions that are given by NPV and IRR are the same. No conflict exists between them. But wherever I am looking at a mutual exclusive projects, means I have to choose only one of the different projects that are available. So which means the highest ranked one needs to be chosen. And what we really find sometimes is, while NPV will rank project 1 as the rank 1, IRR might rank project 2 as the rank 1. So the rankings could differ between the NPV and the IRR, though if they are independent or single, the decision criteria does not differ between the two. But whenever the ranking is important and that too mutually exclusive projects are there, we see that there is a difference that comes up. Probably even in our example, you could see that in this case, NPV is saying that project 1 is having a high NPV. So it is ranking project 1 higher. Whereas if I look at IRR as a base, it is saying you should take up project 2 than project 1 because IRR is higher for project 2 compared to project 1. So they are giving different rankings. NPV is saying choose project 1, IRR is saying choose project 2. Especially this problem comes up when we are talking of the timing of the payoffs timing of cash flows, and second is the size of cash flows. So it is in these two situations I see that NPV and IRR can give a conflict. Probably here in this example you could see initially the amounts that are coming are much lesser, but at a later point the amounts coming are higher here. Whereas here initially higher amounts are being realized and later point very small amounts are coming up. So it is in these kind of situations I may very clearly see a conflict between NPV and IRR, right, where majority of the cash flows are realized in the earlier periods versus in one project, whereas in the later periods a big lump sum coming out in another project. There is a possibility that the NPV could be higher per one project and IRR could be higher for a completely different project, which means the ranking criteria could completely differ. The second thing I talked about is the size of the cash flows. So here minus 100 and minus 50. Probably that it is one more scenario. One project could be a much bigger project giving me a lesser rate of return. Very big project giving me a lesser IRR, and a small project giving me a high IRR. Now probably from a value addition perspective, let's say if it is $1,000 million project and it is giving me a 5% IRR or 5% rate of return, the overall profit or value addition that it is giving me is around 50 million. Whereas a small project, which is a 100 million project, even if it is giving me a 15% rate of return, overall I am getting only 15 million added to my overall portfolio. So the NPV might rank this as higher because it is giving 50 million extra value addition in terms of dollars, whereas IRR may rank this because it is coming out to be 15%. So especially the size of the project and the timing of the cash flows really create conflicts between the NPV and the IRR decisions. And it is very clearly advised that whenever such a kind of conflict comes up, always make your decision based on NPV. Whichever project is having the highest NPV, try to choose that project, not the highest IRR project. A few reasons behind that. One, NPV is the dollar value. It is directly related to the shareholder wealth, addition to the shareholder wealth. So any big dollar addition is a direct welcome. So investing small amounts and generating bigger returns is like keeping the cash idle without doing any investment, which will fetch nothing. So one, because NPV is directly related to the shareholder wealth maximization, whereas IRR is more of a return which the project is giving. So NPV is more and more preferred. Two, the reinvestment assumption. We are discounting all the cash flows at R, which is the required rate of return, which is the market realistic kind of a rate. Means we are assuming that whatever the cash flows that are coming in the middle, they are reinvested at an interest rate R only. Means there is a possibility to reinvest them at R, because that is what is the rate of return I am expecting. That is what is my opportunity cost when I have gone ahead with this investment. Whereas on the other side, the IRR assumes that the reinvestment of all the intermediate cash flows happens at the IRR rate itself. So which means if the IRR is around 20%, it assumes that all the intermediate cash flows, whatever that are coming after 1 year, 2 years, 3 years, they are reinvested at that 20% rate only, which in reality may not be possible, So we do not look at the IRR return as the most realistic kind of a return, but whatever the R that we are using as a part of the NPV calculation, we see that it is more and more realistic compared to that of IRR. So that's one of the prime reasons. If there is any kind of conflict between the NPV and the IRR, it is always suggested that we go ahead using the NPV. Whatever the project that gets ranked higher based on NPV can be used for taking the decision. Only in few cases we see that this kind of conflict will come up, but whenever it is coming up, that is what we can very safely assume. And generally we look at IRR for very short term investments, small investment, and for shorter periods of time. I can very well look at the IRR, but whenever something is for a longer term, it's always better to rely on NPV itself compared to the IRR mechanism. And what we also will be seeing is, in some cases it is very much possible that the IRR, whatever we are trying to compute, there can be multiple IRRs, or there could be no IRR as well. Even this is adding up to the problem, whereas NPV at any point there is only one. Whereas with the IRRs, we find this multiple existence or even no existence also. So probably just as an example, if I am looking at 3 periods 0, 1, 2, right now I am investing some $1,000, and let's say I would be getting let's say $7,000 after 1 year, and I have to pay $12,000 after 2 years. So let's say these are my cash flows. Means this is a non-conventional cash flow, because I am seeing two different sign changes occurring, a negative to positive and again from a positive to negative. So it's a non-conventional kind of a cash flow scenario. And even if I try to discount it, okay, minus 1000 plus 7000 divided by 1 plus r minus 12,000 divided by 1 plus r squared. So if I take out the thousands altogether, it's like minus 1 plus 7 by 1 plus r minus 12 by 1 plus r squared. Now just for simplification, just trying to do it so that you can understand the concept clearly, it comes out as minus of 1 plus r squared plus 2r plus 7 times 1 plus r minus 12. This is what is the value that is coming out. So this should be equal to 0 for me. So this is equal to 0. So on simplification, it is coming out as minus 1 minus r squared minus 2r plus 7r minus 12 equal to 0. So probably taking it to the other side, it comes out as r squared plus 2r minus 7r, giving me minus 5r minus 1 minus 12 minus 13, going to the other side is plus 13 minus 7 plus 6. So giving me r equal to 2 or r equal to 3. So which is in other way working out as r equal to 2 is nothing but 200% and r equal to 3 is 300%. So probably what is coming out is, for these kind of cash flows, in one scenario where my r is 200% and r is 300%. So probably what I can look at is the cash flows, just putting up the cash flows, time periods 0, 1, 2. I'm looking at the cash flows, in this case minus 1000 plus 7000 and minus 12,000, right? I am discounting them with NPV of 200 and NPV of 300. Now probably let me try some discount rate. So when I'm using a discount rate, let's say of 25%, the present values coming out to minus 1000 divided by 1 plus this discount rate to the power 0. So these are the cash flows that are coming up, and from here I can say that my NPV is going to be the summation of all these things resulting in minus 3080. Now what I would like to do is I would like to find out for different possibilities. So I'll take 0%, 10%, the different discount rates, 0 to probably up to 350% I'll take. And with this I'll try to see what is the NPV in each of the cases, and after that try to even plot the NPV profile as well. And what is being observed is when I'm doing the computation of the NPV in this particular case, what I could see is just a simple graph will give me a better idea of the same. I'm doing a simple plot for these two, and all I could clearly see is all I could clearly see is probably let me try to plot it in a very smaller area compared to this much. So let me try to plot it from 100% to the positive side rather than the entire thing being taken into a graph. To understand this flow, what we could see is this particular graph is cutting the x-axis at two different points, here as well as here. And what we could see is it's not a convex kind of a graph coming smoothly, which we have seen in the earlier cases. So it is initially starting with a negative, positive between the two IRR points, and again going negative. So in this kind of cases, especially when there are non-conventional kind of cash flows, we could see that there are possibilities of multiple IRRs, because the reason is IRR is nothing but whenever I am expressing it as an IRR equation, it is nothing but the present value of the cash flows, and it's basically a n degree polynomial. Trying to understand it much more in mathematical terms, it is nothing but an n degree polynomial, and at the max this nth degree polynomial can have real roots based on the number of sign changes. So here there are two sign changes that are occurring. So at the max there could be two real roots, but definitely not more than two, but at the same time need not be two also. So when there are two roots means there are two IRRs. So we might be very much careful. We might have to be very much careful about that kind of relationship that comes in IRR. And that's one more reason why we may not prefer the IRR compared to the NPV for evaluating the investment decisions. Alright. So likewise, there might be a possibility of no IRRs even. Just like there is a situation of multiple IRRs, there might be a possibility of no IRRs also. For example, if I visualize, okay, the cash flow 0 is 100, CF1 is minus 300, and CF2 is 250 or something. It is very much possible that the IRR may not come up in this case at all. Means there are instances where there are multiple IRRs, there are instances where there are no IRRs. It doesn't mean if something does not have an IRR, it doesn't mean that it is not a worthy project to take up. it might very much be possible that IRR is always positive, the NPV is always positive. There is no way NPV can go negative in that case, which means it's a very, very profitable kind of a project to get into. So, what we really see is with an IRR, depending if, and that too, especially if it is a non conventional cash flow based project, what we typically see is there is a possibility of no IRRs as well as a possibility of multiple IRRs also. But if it is a very conventional kind of a project wherein we look at only one sign change occurring, all negative cash flows initially followed by positive cash flows, there will be only one IRR. As we have seen, that IRR is nothing but an nth degree polynomial, and it cannot have more than the number of it cannot have more real solutions than the number of sign changes that have occurred. So when there is a conventional project, at the max one real could be there, which means at the max one route can exist, and the IRR can be only one. But only if there is a non-conventional stuff, there is a possibility of multiple IRRs or no IRRs being present. And now what we are looking at is in real world, how popular are these methods in the industry. Now that we know that these are the way they are calculated and all, it is observed that in European countries there is a lot of dependence on payback period kind of mechanism, easy to understand, whereas in the American countries we see there is a lot of drive towards NPV and IRR based mechanisms. And what is also observed is generally large companies they prefer this mechanism, whereas small companies are preferring this kind of a mechanism, the payback period mechanism. And a lot of private firms are focusing on the payback period mechanism because they want to know how quickly they can get back their money. But lots and lots of government and public kind of organizations are relying more and more on NPV and IRR. And apart from that, it also looked like people, if this company is managed by people with good education background, probably MBA, such kind of heavy education background from a premier business schools, if they are being managed by, if the companies are being managed by these kind of people, there is a very strong motive towards using NPV and IRR compared to those companies which are managed by people with non-MBA kind of a background. So that's how we can very well differentiate. I mean, this is a result of a survey which might be prone to some limitations in itself, but typically, normally speaking, also any of these corporate finance based tools, capital budgeting kind of tools, they are very much essential for managers, both from internal evaluation perspective as well as external analysis. And I say external analysis, probably looking at mergers, acquisitions, investment decisions, all these things. And as we have seen, NPV is more and more related to the stock prices as well, because NPV is an increase in the wealth of the company. So any increase in the wealth is targeted towards an increase in the stock price in the reality. So the whatever is the expected NPV, that is going to be increased, the value of the company, and hence the stock price are going to get reflected accordingly. But yes, any positive NPV project, the analysts would expect that the company's profitability would grow by this much extent, whereas in reality it grows only by this much extent. In that case, instead of increasing, the stock price can fall because the investor or analyst has already expected that it will go up to this, and he has got into his investment decision, because the typical value of a firm is nothing but the current investments, whatever are there, the value of the current investment along with the NPV of all the future investments. That is what is the typical value that can come out for the firm. Now, if this value, if this NPV of the future investment is being expected at this particular level and has been valued by the analyst, in reality it meets only up to this extent, which means there could be a reduction in the stock price as well. Though it's a high NPV, positive NPV kind of a project, it could very well result in a fall in the price as well. And one more dimension from which this capital budgeting projects would be typically looked at is the assessment of the quality of management. To what extent the management is really bent upon the goal of shareholder wealth maximization, to what extent the company's management is more and more focusing in that dimension, and what is the kind of effectiveness that it is showing in terms of implementation of those kind of aspects. So a good understanding of the different tools of capital budgeting along with their limitations and along with the comparative understanding of all of them is very much essential to make good investment decisions. All right.